expectations and projections for the precious metal gold in particular, which is a little odd because normally in the past, I would say 80% of the time I tend to trade in silver if I see an opportunity, because it tends to be on average a more volatile instrument. There are presenting to me, based on the last week or so of analysis I've done, some specific relationships presenting in the gold market that would cause me to focus on that. But more or less, because of the high degree of correlation, about 70% correlation between gold and silver, the analysis I discussed and the relationships I mentioned today will be equally applicable to silver, but primarily I'm going to focus on gold. All right. Those of you know that a lot of a foundation of what I do is based on market timing. The idea, the basic fundamental concept is all price returns from a causative fundamental standpoint I expect arise as a function and in response to certain specific time periods which have elapsed. So I typically start there. Yeah, I do believe in the fundamental, most essential technical, the premise of that underlies and is the foundation of technical analysis, which is all price or trend discounts all information, the information that we know about and even information that we don't know. But if I'd like to acquire greater insight and understanding as to why certain things are occurring or a certain type of behavioral features are occurring in a market, I look to time. And if I can establish certain time periods that correlate with certain types of price action, I usually come away with a greater understanding of why certain markets are doing what they're doing. Money flows towards greatest rates of return. That's just an obvious fundamental money-capital flow relationship that I think about as a backdrop to establishing or locating good trades. This is just a slide indicating certain intermarket connections. In general, if you're depending on the currency, the US dollar, you can see the corresponding tendencies. If dollars go up, commodities go down. It puts pressures on general commodity prices. CRB index drops, bond prices rise, or interest rates, and as do stocks. If the opposite scenario occurs, if the dollar declines, it lifts or bids commodities. You see a rise tend to see commensurate increases in interest rates, which in turn put pressure on the nominal interest rate instrument like a 30-year treasury or a 10-year note or whatever. And that also increases borrowing costs, so it puts pressure on corporate entities such as paper assets like stocks. And then that's usually a starting point typically by which on a macro sense you can evaluate where the different capital markets are going to move or how they're going to move. You have to adjust that for inflationary or deflationary periods. Here's my general premise, and this is leading us to what I expect will be a good position trade opportunity in the next few weeks to months. So what I'm referring to today primarily highlights and points to what I expect will be a very high probability, good reward risk trade in gold, and I'm bullish. Which is and again, but it's specific to this time window for the next 3 weeks to 3 months, let's say. I projected out that far, and the final slides will show you in more detail based on some harmonic analysis I've done just in the last few days, literally. But it's based on the idea that from an intermarket standpoint that would relate to this, I'm expecting that we're a little overdue for some correction in the dollar, in the currency. And I think the next chart or the next couple of charts will indicate this. So if we're expecting, as I am, and if I'm projecting weakness in the dollar, that would lift commodities, and so that would be raw and hard commodities such as metals or gold, put some pressure on bonds, and ultimately we should expect a decline in stocks, even though I just established a long position, or I should say reestablished longs in stocks yesterday. I've been long in the stock market in the ES since the first week of November. November 4th I had a time point. So, but overall I do expect that we're due for corrective forces to push dollar prices down, even though yesterday's trade in response to the non-farm payroll report bid the dollar up. But I think overall I expect we need to see a kind of a regime correction in the dollar. So let's see, we have a question already, I think. Gold going up, suggesting topping out of the bullish run. That makes sense, yeah, but I am expecting, even though there are really no indications in a tangible, intrinsic sense of inflation, I think the central bank will be starting. They're certainly on a policy monetarily of going to, during the course of this year, 2017, we're going to see higher rates, all other variables isolated. And as such, it's an indication of inflation. I don't really see real strong signs of inflation, but that's not to say we can't. So there's a scenario where stocks, for a brief period, I expect, can run up further. I think we're nearing the end of the generic bull market in the stock market. To be specific, I've got very critical time points coming in for stocks, the paper assets or equities in particular in the United States at the end of this month. January 31st through February 1st is actually a 2 or 3 day window there. So I'm expecting a further appreciation. On an intraday basis, we broke through the all-time highs in both, I believe, the Dow, the YM, and the ES yesterday. I know in the ES, I'm not certain. I think I checked the Dow, and I think intraday we got up. If we didn't break through intraday on the Dow, we got close to it. But certainly we, on an intraday basis, formed a new high yesterday. We didn't close above the all-time high, but we're very close, and I expect we will. I think psychologically also, the market wants to see a 20,000 Dow Jones, and I think I had a time point December 27. It actually came in on Christmas Day, the 25th. So since the market, that was on a Sunday and it was a holiday, and also the last Monday, the 26th, was a holiday. I pushed that out to the 27th. So essentially, the trend that that we see begin in stocks in the United States, I expect will persist through the next high probability point or in this case window. It's a 2 or 3 day window. Again, January 31st through February 1st is the next turn point, and again I have about a 90% expectation in the reliability of that pertaining to stocks in the United States. So overall, assuming, on an assumption we're going to see follow through and persistence of such to the upside, that might very well correspond with what could be a significant pivotal top in stocks. And in the meantime, between now and then, more or less, I expect declines in gold. So there's an opportunity here in the next week and a half to 2 weeks in particular, and I'll get into the final slides will in more detail to indicate how we can get positioned in long trade, for a long trade or a long campaign in the precious metal or in gold market. So yeah, hopefully that addresses your question. Yeah, it does, in and of itself, gold going up does suggest a topping out in the stock market. Okay, so here's vis-a-vis that relationship chart. This is the long term. This is a 5-year chart of the U.S. dollar. So I just realized I didn't put the markings from a wave perspective, but you can see over on the left side of the screen, guys, from the very bottom back in January of the beginning of 2012, we had some bottom area. That's the start of a bull market cycle. The top that came in about the summer, July or so, or you could push that out, July of 2013 is probably the end of the initial impulsive measured move or wave one in an Elliott cycle for the U.S. dollar. Then we had significant declines into the end of 2013, first January of 2014, marking the end of what, from a technical standpoint, an Elliottician would call wave 2. And then you see the abrupt rocket-like launch move of classic wave 3, where it just went almost vertical in the summer from about the middle of July through the first quarter or so into the spring of 2015, the top. That's the end of wave 3, and then everything since then into the spring of January 16 was your classic fourth wave. All of that period where the market was trading in a range of between about 100 and 94. That's you can see the choppiness, the ABC kind of rectangular fourth wave, and then from about the bottom that came in just in April or May of last year, 2016, up to the present is your fifth wave, I expect. So you've got a very nicely formed textbook strike longer term. This would be kind of on the primary degree of consideration on the degree wave, taking into account the idea that a primary degree has about 8 waves or roughly in about a 4 plus or minus year span. So you've got 5 of them here, and assuming, now we could have a little further appreciation in dollar. You can see we've recently, and this is again the weekly chart, a weekly continuation of the dollar index. So for the last month or so, we've broken out above what was the previous high that I believe the third wave established back there in 2015. In the first part, the first 2 quarters of 2015, when we hit that top in a dollar, that was corresponding to the wave 3. Then we abruptly went sideways for a period of months, an extended period of time, very classic textbook wave 4 type structure, finally bottoming out in what was about the spring of 2016, and then ascending higher into the present in what would be what I consider or interpret in my count to be the fifth wave. As such, we're due for an ABC correction. So technically, from that wave vantage point, I do expect declines in the dollar. We're overdue. We need a correction. After that, longer term, going out possibly into the final 2 quarters, the final half of 2017, I would expect a resumption of bullishness in the dollar. So longer term, meaning that, you know, by the end of 2017, it's quite possible the dollar could be at new heights. Interestingly enough, we might augur and try and conjecture what type of events would be consistent with that. But at least technically, this presents a backdrop in a broad sense as to why, as I'm going to connect this to my expectations for the precious metals, gold in particular. Okay. All right. So essentially, this is just a reiteration of what a couple of slides ago I indicated, and I'm going to go with the scenario depicted on the right side here. If I'm expecting corrections in dollar values, which I am, I'm expecting the dollar to decline. That would be price supportive for oil and the metals and stocks. If the markets overall, if capital markets in general perceive the specter on the slightest bit of any inflation, okay, I'm not really seeing that in a wholesale way across the different indicators that one would think yet, but to the extent the capital markets at large en masse expect inflation, we're certainly going to have a monetary policy, all variables expected, assuming we don't see data in a general fundamental way tying or holding or limiting the Fed. I expect interest rates to rise, and that will eventually that will be price supportive for the dollar. But for the next few months, I expect again the technical factors to overwhelm monetary policy, and that will put pressure on the U.S. dollar, and in turn price supportive for commodities at large. Certainly the energy sector I think will go up, and certainly precious metals is an opportunity here. Within a broader, longer term, more globally, if you look at a monthly, go back 20 years, I still think precious metals are in a bear market. But again, my time horizon here now is the next few weeks to months, going out to the middle of 2017. I expect by June, and I have a time point that I'll indicate for gold in particular, coming in June 22nd. And so by the middle of the year, I expect significantly higher metal prices. After that, I'm not as certain, but well, let's see. So again, the scenario is starting from this premise that I think we're due for a significant additional correction in dollar values, and that in turn should correlate with a lifting of metals and oil prices. The stock situation, again, I expect further appreciation at least for the next to the end of this month. Very short, relatively shorter term. Beyond that, we'll see. But I've got a very trustworthy, reliable cycle coming in, a confluence of cycles rather, at the end of this month, January 31st to February 2nd. So again, further appreciation in stocks coordinated with declines in metals through specifically, as you'll see in a minute, the 18th. So that's basically a week and a half from now, today being the 7th, the 18th of January. So there's a clear strategic opportunity to get on board long positions if you agree with the in aggregate with everything I'm saying. This is a chart. This is last year. This is the daily chart of gold. Let me just see here, guys. Any questions? All right, nothing yet. All right, this is go back to the fall, about the third quarter of last year, and this is a daily gold chart. And at the time, I was thinking that I was very bullish potentially because I was looking at this as a bull flag type structure. I thought this was this top here, the highest point in the middle of the summer, July, that actually came in July 6th, if I recall, that actual top, the 2 days after the 4th, and I was interpreting everything to the right of that through the fall into the third quarter as being kind of a fourth wave, or from a classical vantage point, thinking of it as a flag type structure, typically expecting a continuation to ensue and a breakout to the upside. In retrospect, I was wrong. This fluctuation in here ultimately, given my current description in wave count, is the individuation of an A wave. In other words, that top here, the highest point on this daily chart in gold, which came in on July 6th to be precise, I now believe to be the end of a fifth wave of a bull market cycle, and everything, all the price fluctuation that ensued were the individual 5 waves that were internal to an A wave, the AB of what would ultimately form as the ABC correction. So I thought it might be interesting to present this slide, even though it's old. It's a year. It's going back into last year's activity. Curiously, though, I think I gave a presentation on the metals at around that time, and was interpreting this as a bullish, a harbinger of higher prices more immediately. I was expecting a breakout through the upper side of the triangle. We didn't see it, because now I know that this was the internal 5 waves of what ultimately formed as an A wave, and depending on the particular contract you would have been observing, it's a little more acute angle, as you'll see actually has occurred. But this, everything from the top here, July 6th, ultimately now I understand is an A wave, and then I'll show you is on the next slide where we are. Well, actually on a couple of slides, but this is the long term. This is a 5-year view of gold, weekly chart of gold, and this brings us to the present. So here's my wave count, and this is getting into a little more precise explanation specific to gold as to why I want to do. I think the money will be made in the gold market right now. Okay, what do we have? This is my count specifically going back to the beginning of 2012. If you see the temporal axis, the horizontal scale down here at the bottom, starting at a top that came in on the week of February 27, 2012, I believe. Now, let me put this into context. Everything here, actually, no, I was wrong. I jumped the gun. All right, going back, this is a top that occurred in February of 2012, and I believe the decline into May of the same year is your wave 1 long-term count, and this illustrates or presents what I expect would be defined or classified as a primary cycle. Primary meaning the degree. For those of you who are not familiar with Elliott analysis, there are different degrees which simply indicate a window or an amount of time within which we can expect a certain number of waves that constitute market cycles, and this is the theoretical premise of this model. Market motion occurs in waves, and a set of waves, 8 in particular, constitutes what this model suggests is a cycle, and cycles in turn sum and add together in varying ways to form the price action and serve to propagate a market's motion forward as we move forward into time. Okay, so with barring that, the particular way, looking backwards, and the best description and the best fit that I've been able to construct is, if we look and see, starting going back 5 years, the move here we see, this would be and then think of it upside down, a set of 5 waves going down. For those of you who might be a little confused, I've got a wave 1. It doesn't matter. You can shift the orientation. but it's the basic structure that's important. You've got two major types of motion, waves that are occurring in sets of 5 and sets of 3. Okay, that's a little bit of the theory, but more important for today's presentation, I want you to catch the description insofar as how I'm incorporating it or integrating it into a reason for an opportunity. All right, so if this top here in February, if that's the start of a wave 1 going down, your correction wave 2 is going up to the top, very classic wave 2, almost 100% retracement, October of 2012. You have a wave 3 in June of 2013, and all of this structure from this, all of this, this is your A, the B, the C, the D, and then the E of a triangular fourth wave completing in November of 2015. That's your fourth wave. And then you have the final motive or impulsive portion of the set of 5 waves that began back there at the beginning of 2012, first quarter, February of 12, into November, end of I almost said the end of last year. I got to remember we're now in a new year, 2017. But if we had been talking a couple weeks ago, I would have said the end of last year. But it is what it is. The November of 30, the end of November, first part of December, we had a major bottom come in gold prices. Okay, ever since the end of 2015, gold prices have been advancing to higher levels, as you see. And I conjecture, my expectation is that that is served to form, from a Elliott perspective, the first leg of a correction, the A wave. You have an ABC. The basic premise of Elliott wave is you've got 1, 2, 3, 4, 5 creating the major, what's considered to be a primary trend, followed by a correction of that takes the form of what we refer to as the 3-wave correction, or the ABC component of a cycle. That set of 8 waves, 1, 2, 3, 4, 5, ABC, labeled as such, just conventional nomenclature, constitutes one cycle, after which a new cycle begins, serving to perpetuate that given trend. So here's the A up to the top of July 4th, 16. That's the very same top that the previous slide, right here. This top right here corresponds as the exact, more or less, same data point as right here, as just observed on a different time frame. It came in on the week of July 4. It was actually 2 days into that week on July 6th. Okay, that's why, and the majority, or at least the first 6-7 months of 2016, served as the window of time within which the A, or a portion of the correction, the A wave, formed. Okay, that's why we saw the appreciation in gold prices for a little just over the first half of all last year in metals, gold and silver, and platinum, by the way. Okay. Now, since the middle of the summer, the middle of last summer, we've been declining into the end of 2016, and that's the B wave, I believe, as you see here. So this is very important. This establishes a global kind of backdrop of understanding the historical trajectory that we've seen in place in gold. And that will serve as a kind of launching pad for, at least in part, why I am expecting further appreciation. Okay, well, number one, before we leave this slide, let me just say, if in fact this is a significant bottom on December, that came in the week of December 12th, middle of December of just a couple of weeks ago, literally. If that's the end of the B wave of a correction, what should occur theoretically? Again, you have an A going up, a B coming down, and you'd expect a C to take the market higher. So in a macro perspective, a macro sense, that's a factor that I expect will be price supportive and serve to bid the price higher. You can see when I printed this out just 2 or 3 nights ago, we were trading at 1160. That's on the weekly view there, you can see. So again, a component, one of the spokes in my analytical wheel, as it were, would be as to why I'm expecting higher prices, simply as a consequence of this longer-term wave picture, which would indicate on the premise that this bottom that came in a couple of weeks ago, middle of December, is in fact the end of the B wave. We are due for the onset, the beginning formation, and I expect, in fact, that's why, since that middle, it actually came in on the 16th or 17th, I think, you'll see, I can't remember the date, but to the day, but it's actually 2 days from a previous bottom this bottom here, as you'll see, and the daily chart in more detail. But that's why the market in the last few weeks has been rising. Okay, and it's the marking or indicative of the onset of what I expect will be a C wave somewhere up here. Okay, so that's the big picture going back 5 years. Here's a detailed daily chart of gold, just showing the pretty much the entire year of 2016 through the present. I printed this out just 2 nights ago. All right, let me just see before any questions on the previous slide. So far, so good, guys. All right, can we still, are you guys still with me? All right, good. Now, this shows in a little more of the microstructure, not, relatively speaking. This is, we're moving from the weekly to the daily chart. And so it's very interesting. There are a number of properties that I'd like to explicitly bring out here that the daily chart illustrates. This is the near-term February contract in gold. And this is the bottom, December 17, from what was last year, but now is 2 years. It's not 2 years, but 2000, it is what it is. December 17, 2015 bottom. I am maintaining that this bottom right here, if you can see the pointer, again, the date of 12/17/15, this is the daily chart, is essentially, it's not exactly, it actually, there was a double bottom here. In other words, it initially came in on November 30th, the end of November, and then it had a double bottom that I didn't mark on this weekly chart corresponding to the date of December 15. Although it's not indicated, I could have, if I wanted added detail, I could have indicated that you can see the little double bottom even on the weekly chart. It came in on the day, first the market initially bottomed in the end of November, the final week of November, and then double bottomed again, or have had the same bottom at the same price essentially, if I recall, within a matter of a couple of points literally, on December 15, the actual day of December 15, 2015, even though that date is not indicated on the weekly. And that point is this point, or it actually came in on December 17, excuse me. The 15th is this year. That came in 2 weeks ago, or 2 weeks and a fraction, or whatever. Okay, so that's the starting point. And so all of this price appreciation we saw for the first 7, 6 and a fraction months of December's of 2016 marked or illustrates graphically the formation of what this weekly chart on this weekly chart is putting into context and is suggesting, according to the description, is the A wave of what will ultimately form as the larger ABC corrective portion of a long-term bear cycle. Okay, so all of this move from this bottom, the lowest point in the weekly chart, up to the top that formed on July 6th, now was the A wave. This is the A. And what this chart is just showing a little more of the detail, showing how to substantiate my count, in other words. If this is an A wave, we know technically, if you do, if you don't, just take my word, if it's an Elliott, it's a tenet of the model, it should subdivide into 5 little waves. Well, we see structure during the course of the initial 6 months of 2016 consistent with that theoretical attribute. Here's your little 1 of the A, the 2 of the A, the 3 of the A, you have the 4 of the A. This is even the A of the 4 of the A. This is the RTB or B wave of the 4th wave of the A, if you want to get drilled down another level of detail. This is the little 4th, excuse me, this is the C of the 4 of the A. And this peak up here, this date of July 6th, marks the end of the internal little 5th wave of the larger A wave, of the which is a part of the ABC correction. If that's the case, which I believe strongly it is, everything that follows the decline, and this stuff in here is that decline that I showed on that previous chart that I said a year ago I presented in a seminar. And at the time I was thinking it was a bull flag and I expected a breakout to the upside, and I said in retrospect, well, you can see obviously why it broke down below the lower side of the triangle. I now understand why. Clearly this is an ABC correction. And so all of this is the A down here. It's got a convenient bottom. This is November 2nd. This is the 22nd. The reason I didn't mark the B here is because that's the the shadow of a candle, we had already begun to decline in order to form the C wave of the bigger correction. So this is a more relevant, substantial top that I felt more aptly deserved the ending point, because the market had already begun its C wave formation. This was kind of a extraneous, who knows what was happening. I can't recall what was going on there, but it's at relatively of lesser significance. All right, so here you can see my count. This is the everything from July 6th. This is the A of everything from July 6th top to the bottom that came in like 2 weeks ago, middle of December, literally December 15, on that day. Now, that's your ABC correction. Or excuse me, that's the B wave, excuse me. This is the A wave up here, going back, lest we forget, everything from the bottom December 15 up to July 6 is the A of that corresponds with a cycle that began in February of 2012. Again, 1, 2, 3, 4, 5, A ending at the top of July 6, B ending at December 15, just over 2 weeks ago of 2016, which is this point right here. That's the B wave. Again, reinforcing my expectation for why you would I'm projecting higher prices. We need to form C to complete the cycle. And that's a major reason. This is just presenting a little more of the micro structure that is supportive of a bullish view, or a view that would support a further bidding up of precious metal, gold in particular prices. We are just at that point, to the extent I can have confidence that this is a valid ending point for the B wave of the bear cycle that we are currently in. We are due for a C wave to form, and that will have the net impact of lifting gold prices or precious metal prices in net significantly higher, I expect. All right, another point that could serve as an adjunct of analysis I'd like you to see. This entire chart, the daily chart, which lasted from, it's off by 2 days of being exactly a calendar year, from December 17, 2015 through December 15 of 2016, essentially 1 year. We're 2 days difference. That's 1 year to be almost exact, barring 2 days of difference. Notice that what took place, you have an ideally structured entire cycle serving to form the larger degree A wave and B wave. And it is also in a completely but adjunct as a complementary alternate form of structure. I want you to see the relationship. It is more or less a textbook Gartley structure, if you're familiar with that. This being everything from the bottom of December 15 through the top of July is your XA, or your initial thrust, and then you have a retracement. This is why I've indicated, look at your 2 critical important levels of retracement consistent with the Gartley, 61.8%, 78.6%. Fibonacci retracement to the tick almost is the bottom that formed, creating a textbook Gartley. You have the A, the B, the C, and the magnitude of the retracement of the previous thrust is a textbook Gartley. Further, from a completely different theoretical vantage point, suggesting that I would be expecting lift or support in metal prices, gold in particular. Could it be coincidence? Certainly. I'm just presenting that for our consideration. Also, the internal Fibonacci's that are consistent and indicate more precisely a proper Gartley formation are present. I just didn't indicate them because it's not as paramount of importance as is the broader wave structure. But as an ancillary or adjunct additional relationship. Already, so we're seeing, if you look at everything to the right, or all the price action that has formed since 2 weeks ago, since that bottom that formed in the middle of December on the 15th, is marking marking the end of the B wave, I expect. We've also seen the beginning of the C wave. And there's even internal structure. This is a little compressed, so the subsequent slides will show it a little more clearly. This is the 1, the little top here, if you can see it on this chart, the 2, and already the 3 of what I expect, little internal substructure of a 1 of the C. That's why. So there's no mystery as to why in the last 2 weeks we've seen the net trend in metals prices rise. It's forming the internal first measured move of what will ultimately, in my count, be a wave C of a larger correction. All right, so we now want to, if we want to really hone in on this and outline an opportunity, we want to put some time, overlay some time components on this. All right, so here's a time price grid. Same chart, just I adjusted the scaling so it's easier to see with some specific time points. This is the gold, the February gold contract. These vertical lines indicate time points. These are recent past ones. They're of no practical value, but they show a pattern of analysis that I'd like to present. This vertical, that was a perfect hit. This was, well, it was not a top, but it was indicative. It indicated an acceleration of trend. I did not trade that, but I am just I projected it months in advance in the same way that I projected these out way in advance, as you see. But just to give you a sense of a continuum of analysis and how there's analysis in theory, and then there's the real world, what the market does, and sometimes they're congruent, sometimes they're not so, but you get a pattern of expectation. This was a perfect top. It came in on the 27th. You can't see it because the line is covering it. And it's set up for this final internal fifth wave of that larger C wave, of the larger B wave, if you have, depending on the degree of detail and microstructure you're interested in focusing on. All right, and so this is the bottom. I didn't put this date here, but this is essentially the very same bottom that's 2 weeks ago, December 15, as observed on this chart that illustrates the time and price, or time and some price projections I've generated. Okay, so here we are. I printed this chart out 2 nights ago, and I think yesterday, well, you'll see, but my next important time point, this is where we are right now, and this is the next time point, January 18th. So today is the 7th, where we're talking, what is that, about a week and a half or so from right now. Curiously, coming in 2 days from a scheduled, obviously the scheduled event. The inauguration is on the 20th. So it does suggest a possible correlation. You know, what's going to happen? But leaving that aside for the moment, we can always revisit and reflect on that ad infinitum. The point is, I have a lot of confidence in this 118 date. These vertical lines do not intrinsically themselves specify top or bottom formation. All they indicate, at best, is an indication of high probability for a change in an attribute or a feature of the market's motion. That's the significance. Now, again, I always tell people when I'm teaching cycle analysis and market timing in a broad sense, interpret a time target for which you have confidence as a point or a window of change. If the market's trending up at the point of arrival to that projected time point, if you're confident in it, you would more likely, at least in a facile, simplistic initial sense, expect it to more likely form a top. And the opposite scenario or phenomena is true. If a market at the time of touchdown on a temporal time point is falling, you would expect it more likely would manifest and form as a market bottom. But that's an assumption. Nowhere is it written in pure cyclical interpretation that we must mark. It indicates more broadly or generally stated change. There are varying types of change. Obviously, a top and bottom is a graphic picture of the most commonly thought of, but not certainly the only type. Okay, so this is my next time point. I've indicated February 21st is the next one. That's because just yesterday I did some research, and the next subsequent slide will show I have one in here on February 1st that I didn't put in just to create more of a progression during today's presentation. But 118, February 21st, and all the way out here, June 21st. You might say, well, so what? That's of lesser urgent value or interest right now. Yes, but it could help us in trying to piece together the specificity of trajectory that we can expect gold prices to travel, on route to that longer term time point out there. Okay, so we at least begin to see a little bit of a grid of expected price motion. So this would indicate higher prices into the 18th. I'm going to change that based on if you were to utilize the simple starting point. Again, if this is pivotal and we don't see any change between now and then, we'll see. We would expect this to serve as a top. And I've also indicated a few of the important price targets. These horizontal lines are upside price targets or zones of projected resistance. 1192 and change, 1260 to 1262 above that, 1316 above that. We break out above the 1316 level. My next higher projected level is 1348. Okay, but we're a little ways from that. We're trading at 11 currently at 1173.40 is where the market closed yesterday. So, but this represents a zone of high probability resistance. Depending on how the market responds when we get there, this is the next major zone, 1260, 1262 area. Above that, 1316, and then although it's not marked because it's a little further up, but 1348 area. Okay, so let's move on. This is this chart presents even more detail, and it not only incorporates the Elliott count, but basically harmonic analysis, which a little more detailed. It's an aspect of cyclical theory where you incorporate Fourier cycles, Fourier analysis, more detailed, but it allows for projecting cycles out into the future, and essentially the basic, for those of you who are familiar with harmonic analysis, you know that any periodic behavior can be isolated and defined through a series of sine and cosine functions. Now, let me stop right there. For those of you, if you don't have to, if you're not into the math of that, don't worry. This is why, I mean, I'm happy to go through that, and that's what I do in my consulting. But for suffice it to say, this picture presents a projection based on a more harmonic cyclical analysis, which is essentially a summation of varying cycles that and how they add together, essentially when projected out into the future, gives us a theoretical forecast or of probable trajectory as to how we can expect that instrument to behave. Now, it's theory. It is, to a large extent, its veracity and its reliability depends on and rests on having identified the dominant cycles. And that's where it gets a little hairy in terms of the details. But essentially, to the extent you can identify the dominant or set of dominant cycles, you ramp up the reliability of the projection. So essentially, this is a more detailed. This is the daily chart. I just blew it up to show specific points of it. This is the very same bottom point that I believe marks the end of the little C wave of the larger B wave. The C, as observed from the what would be refined. Let me go back. This is the same. This is the A, B, C. But the entire move from here, this is the A and this is the B. And this is the little A of the B, this would be the little B of the B, and this would be the C of the B. Thus, which is one and the same as this bottom starting point, to give us perspective, blown up on this chart. Okay, and I've outlined here a more detailed projection of how I might, a plausible expectation, more precisely indicating week by week, day by day, month by month, how I'm projecting the market of gold prices to fluctuate and move. All right, based on a harmonic analysis. So you can see this is the daily chart, and I've indicated I didn't mark the wave counts. This is everything from this bottom. This is the date of December, whatever that date. It was the 15th. I always get that confused here. Whatever, 2 weeks ago, the 15th of December. Okay. All right, that's that December 15, and we've been rising since. But notice the internal. This is the little 1 within that 1. This is the 2, the 3, and this here, I am projecting this date. This is the additional date that the previous slide did not indicate because I hadn't discovered it until yesterday. I did in preparation for today's presentation. February 1st. If the last slide had the January 18 date, and then February 21st. So there's an internal date that I had not, based on some alternate analysis that I incorporated. So here we are, and let's see what I'm expecting the cyclical kind of ebb and flow and trough and bottoms and tops I expect to occur, and the corresponding prices to create a more fine-tuned roadmap of how I'm expecting gold prices to fluctuate. So here's where we closed. This falling price yesterday in gold, you kind of have an inside down day, was no doubt due to the somewhat supportive employment report we got. We had the dollar curious, contrary to my expectation for a correction, which, but one day does not, one or a few days don't make a trend in the context within which we're looking. But gold came down a little bit. We're due for a correction. Notice the Fibonacci internal ratios here. This is your little 1, this is your 2, this is your 3 up in here, and we're due for a fourth wave. All of this, I conjecture, everything from the bottom, the middle of December, December 15, through February 1st, I am projecting will be the initial wave of a C, the first wave of the larger C wave. And as such, if you look from where we are, this last candle, the black candle on the chart, is yesterday's trade. That brings us through the most recent price action in gold. All right. Overall, I'm expecting further appreciation. How will we move there? I expect we are due for a little bit of a correction, and that would coordinate with my next projected time point of January 18. So that's a week and a half from now. That's why I indicated a few minutes ago, I said if we agree and you expect similarly to me higher prices, someone asked me yesterday in a consulting session, would you buy gold now? Do you get in now? How so? Well, if this is a particular fourth wave and I expect some decline for the next week and a half, into 118, January 18 to be specific, I expect will provide an opportunity to establish segmenting your incremental ways to get on board a long position. If I'm completely wrong, then the idea would be to identify zones of overhead resistance and buy the breakout strategically. Alternatively, utilize what I expect will be a fourth wave type structure, a little internal fourth wave. And by the way, these horizontal lines, this is your price, this level here, actually this is a wrong number, I didn't change that. This is 1166, go back to be consistent. Here's, I didn't even put that on the screen here, I thought I had, but this number should be 1166. So just make a note, folks. This price that I expect we will be at, or roughly at or around 1166 is my price target to be achieved on or around January 18. So right now, yesterday's close at 1173.40. So it gives you an idea. That's a 38%, roughly. We're not going to exceed that. But 1166, utilizing a number of different relationships and models, I'm projecting when, on or around a week and a half from now, January 18. And so during that, so we have a mechanism of price and time coordinates that will facilitate, I would hope and expect, a finer positioning and enabling us to get in at more advantageous prices from the vantage point of bullish view. After which, I expect into the end of the January first part. My actual date came in. It's actually coming in. Yeah, but that's correct. February 1st. I'm thinking I'm jumping ahead again. Okay, so this is correct, and that would complete what would be the fifth wave of the little. Here's your 1, 2, 3, 4 from an Elliott perspective. If you're trying to match, if I'm trying to coordinate and reconcile and dovetail a harmonic and cyclical analysis with a wave count, you would think of it like that, and that's what you want to do. You want to see where disparate models tend to find points of connection or nexus. So so my next time point that the previous slide did not indicate is February 1st, and I could see the market up at around 1198, 1200 area. I want to be ultra conservative here, but the price targets I'm projecting 1198 to 1200, and that would we're due to hit that on or about the 1st of February. Okay, and that's the date that I had just uncovered through some work I was doing yesterday. All right, from that point, now structurally, that would indicate we would be due at that time and price for a correction, and in the format of an ABC, and then you would expect a pullback from that juncture at that point. All right, now ABC, you can see the structure into the end of February, or excuse me, the February 21st date, and that would be have the net effect of forming a correction wave 2 of the larger C wave. This is all the broader correction. After which, and so that's February 21st date. And then that June date that didn't, somehow it got cropped off the chart here. Remember, I had a date out in, I have actually 2 dates here. May 1st, which that didn't seem to make it on the screen here. The next chart will show it. And June, I've already moved out to June. But at least I'm showing the initial formation of the first leg of the broader C, the internal one of a C, through the entire month of January. So the idea, if we're from a strategy standpoint, if we want to establish long positions in gold or any of the precious metals, I'd be doing so in the next week and a half to 2 weeks, essentially, on the idea that we're going to, where we're trading right now, 1173, 1173 and a half, 1174 area, down into a bottom. I don't expect we're going to drop much lower than 1160. The actual number I projected is 1166. This was, I forgot to correct that. It should be 1166. So utilize this. If we start to see price action next week, we're of declining metal prices in response to whatever the trigger was. We had the supportive report yesterday. We might see a little bit further blip follow through the first part of next week in dollar, after which, and then that might, and then we're going to see a resumption by, I would guess, no later than the end of this coming week and topping out in dollar prices. But we may see some follow through here into the following week of declines, allowing for opportunity to establish at lower prices long positions in gold and silver. All right, and then watch out. At that point, I expect from the middle of this month, coordinated with, and again, this is roughly, obviously, from an obvious standpoint, this is 2 days before the 20th, which is the presidential inauguration. I don't know if but all I can say is, I might reverse engineer this, but in terms of trying to expect how markets will respond to events as they unfold in the world, news and so forth. But all I can say is cyclically we're due to move into the end of the month in price and lifting metals prices. Something or things will happen to conspire to be price supportive of that section and that sector of the economy. Okay, so that is a more detailed cyclical view of how I expect gold to move. And then after we get to the third week or so, February, into the February 21st, I'm expecting another advance in what would be wave 3. And that's the big move I'm expecting. That's the money making. Now here's a broader, further out into time forecast. This is everything that the previous slide. Here's your little one of the C. This is again the bottom, starting getting our perspectives in place. This is the end of the B wave of the broader of the cycle that started back in February of 2012. The long-term bear cycle is, I am bringing us from all the way going back 5 years or so, the first quarter of 2012, 1 down, 2 up, 3 down, 4 up, 5 down, ending in December of 2015 is the end of the 5th wave. The first 6 months of 2016 constituted the formation of the A wave of the correction of the bear cycle. The A wave ended again at the top July 6th of 2016. The B wave of our correction is this bottom right here on this slide, corresponding to the date of December 15, 2 weeks and a few days ago from today. And we're going up now, what will complete the final leg, the 8, if it were numbered, it would be wave number 8, but it's conventionally labeled with a letter C, and this slide shows more precisely how I expect that final C wave will form and serve to bid prices considerably higher. Now, I don't know how high precisely, because there are theoretically a number of ways that have been cataloged in the last 100 years based on theory as to the ways by which how C waves. I expect it will be a zigzag, so that could be, say, offer significant price appreciation. But going out here for the next, 3 months or so is what this slide will get shows from a price and time standpoint. This is, you can see where we are. This is printed out last night. This is reflecting yesterday's closing price, 1173 and change. I expect a little, we're due structurally for a little bit of a pullback. Here's the 1166. This is the January 18, a week and a half from now. And then after that correction is complete, a final little fifth wave of the larger one should complete on or about the first week of February. The end of January, first part, February 1st is the date I've projected precisely, corresponding with a price 1198, 1200 area. Then a little bit of correction forming the wave 2, corresponding with the date of February 21st. After which, that completes that little internal cycle of the, that's the 1, this is the 2, all of the larger C, if you can see up here in the corner, because that's proportionally where it may end up. Somewhere off the scale. You can see the highest price level indicated on my chart or graph, 1370. I have already projected, again, I've indicated the price levels, I've projected as high as 1348, so that's up, and here's 1350 on the axis here. But that would, I'm not certain, we could be considerably higher when you consider, go back to where the A started, the end of the, here's your, you look at this scale, 1410. This is the end of the bull portion of the cycle. This is July 6th. So if this is the B, if this stuff coming up here, the entire first 6 months of 2016 is the A, and this is the B, and this is a retraced 62%, that is consistent with a, it's certainly not a flat type of correction or an irregular or a triangle. It would be consistent with a zigzag, which is going to take you into much higher prices. I'm not saying $2,000 gold. I'm saying we could, you know, a theoretically perfect Z wave or C wave of a zigzag would take you to 1,500 conservatively. Now, what I just said has not indicated a time window. It's just saying it's a price projection. But here's where we are, just going out for the next few months. So if this is the little 1 of the C, the 2 of the C, I project a corresponding price zone or range 1175 to 1180. So that, and it effectively brings about a correction. That would only bring us a little higher than where we are right now. Okay. After which the 3 should form, and that typically can be expected to provide a rocket-like lift to prices. And that's why, and my price targets are 1275 to 1289. That's a relatively conservative projection. I used, well, anyway. And that's coming in on May 1st. I have a lot of confidence in these vertical line points in time. I am not certain, I didn't project out beyond any further, I didn't run the cycles out further to that other than to give me a time point. I don't have a corresponding price level there. And I put the C, the ultimate ending of C up here, again, based on proportionality, that could be, you know, this, again, if this is this top here, July 6th, and then this is the B wave, and a C wave of a zigzag tends to be, the A and C tend to be roughly equivalent. So you essentially would measure the magnitude of the A and displace that or project that off from here, and you get a theoretical. That's one way, but that's Elliott. But my cycle and harmonic analysis is a completely different picture. When they dovetail, when they meet and agree, is what I've indicated on this slide, and as best I can. So again, just in the nearer term, I would be looking at the next week to 2 weeks, more or less, into January 18 as an opportunity where I wouldn't be surprised if we see some declines. I don't expect they will be large, though, because it is just a fourth wave correction when looked at, and the run time is not that much. Again, a week and a half to be precise, between now and the 18th of January, after which I expect further appreciation into the end of the month, and that curiously this corresponds with the election. We'll see. I don't know how this is going to play out in an effort to kind of see whether or not it agrees with the series of events fundamentally or not, but needless to say, this is my cyclical projection. So I'll leave it there. Yeah, that's the end. Any questions, folks? We do have, ooh, no sound. Lost sound, election results. Oh my gosh. I'm sorry. I hope we are recording this, so if for any reason I'm not sure and I'm getting some indications, no issues here. Some people are saying you can hear me. Okay, and okay, good. Again, let me remind you folks, we have recorded this, so if you'd like a copy, you can just contact Pacific Trading and they can, or I think for the people who subscribe, we send one out anyway. But if you can always make an inquiry as to the contact information you see on the screen. Peter Newman and Frank Cameron are the people you want to talk to in particular on any issues related to this or anything in terms of PTA. Any questions though? I have a lot of confidence in this. There's some other more details, on a day-to-day basis, minute by minute. I had a cycle. I actually had planned to buy gold or silver earlier this week. Let me just show you on the chart. I'll back it up while I'm waiting to hear if there are any questions. What's the best? Right in here on this day. That was just. On like Tuesday, I had a cycle. It was a lesser cycle point. So, but in retrospect, I wish I was called to a meeting, so I literally did not place the trade myself. So I am waiting. One of two things will occur. Let me just for emphasis sake. If I'm wrong, if this market is so strong and we don't see a little breather that it takes from the and manifest it as a pullback for the next week or so, or week and a half into the 18th, and we continue to forge higher, then I'll identify zones of overhead resistance, such as the levels I've indicated, above which on a closing basis and from a position trading standpoint, I would likely look at as a good opportunity to begin establishing what can be interpreted as a longer term position trade long campaign. Okay, but I have I would say about an 80% confidence that we're going to retreat for the next week to 2 weeks into that 118 time point. And then similarly, tremendous confidence after we pass that we're going to have an explosion to the upside. As such, this 1198-1200 price target is, I would say, conservative, but I'd rather keep it conservative than not. From a wave standpoint, those of you who understand this would be the fifth wave. We know there's a tendency for truncation in fifth waves. By the way, those of you, if my terminology is losing anyone, don't worry about it. The intent is not to teach Elliott wave or cyclical or harmonic analysis in this presentation, rather to present. I'm just citing some of these models that I utilize to make these calculations and derive some of the data points, indicating some of the models I use. For those of you who know the models or theories or have facility in a certain indicator or with a certain form of analysis, great. But don't worry if you're not familiar with the terminology. This is what we teach. If you're interested, certainly any questions you have, I'm happy to address. But it's hard. I can't present a class on Elliott wave or cyclical harmonic analysis in a webinar. You could, certain aspects, but not the entirety of the models themselves. But certainly any questions you have. Okay, somebody has a question. Okay, let me see. The first question, does gold have to correlate to the dollar? It doesn't have to, but there's a general correlation. My answer to whoever said it's Mr. R or Mrs. R, whoever, Trader R, the answer is yes. A literal response. There is a correlation between the currency and commodities, hard commodities, and certainly metals, gold and silver are hard commodities. The basic starting premise is rising dollar prices. You got strength in the currency, that will put pressure on commodities. The CRB index, Goldman Sachs commodity index, all the major proxies or indicators of commodities will go down in response to a support in the corresponding currency in general as a starting point. Now, is it a definitive correlation and it works all the time perfectly well? No, that particular correlation I would say is effective 80% of the time, but it's just a starting correlation. Life is not so simple, and I don't know if that's good or bad. It's just not. It is what it is. There are other relationships that more overlay and nuance and alter That's starting correlation. You know, if the dollar is strong because the Fed, there's a perception by the dollar index or the currency that the Fed is going to raise interest rates. And so again, basic econ 101, and I'm not a fundamental trader, but I can't be in the business but for 30 years and not pick up some fundamentals. I didn't have a background in economics, but here's my thought. If we have signs of the economy revving up on a broad, just very basic fundamental sense, as evidenced by a decent, a pretty supportive employment report such as we had yesterday, then certain paper asset markets, the U.S. currency, the stock market, etc., in particular, those two sectors of the economy, might perceive that the Federal Reserve is more inclined to sooner than later and more aggressively than less aggressively look to heighten or increase rates, interest rates. And that in turn, if we increase interest rates, we cut off the money supply, we lower or we dampen the number of units of currency in circulation, therefore, thereby each unit is intrinsically worth more. Dollar goes up. And since the major commodities, or the raw hard commodities, gold and silver and oil in particular, are primarily priced in US dollars, as the dollar goes up, that puts pressure on gold. So that's a very rudimentary, very basic, kind of simplistic, overly simplistic explanation. But if that's just the starting point. What ultimately at the end of the day you see in any market price, any tangible freely traded market, is going to represent a netting out of a resolution of all the vectors, all the forces. But yes, the literal answer to the question is in general, but it doesn't have to. Gold doesn't have, if something else were to happen, let's say we got a decent jobs report and dollar goes up, gold would by that, say, tend to be pushed down. But if something else happened, if we had if at the same time there were to, not to bring up some catastrophic terrorist attack, and the world we live in 2017 now, we obviously know it's a reality. I hate to bring it up, but suppose, let's just say hypothetically, that type of phenomena would tend to be, it imputes fear into the people, and the people constitute the markets, and in turn, the fear and uncertainty, to the extent based on the extremity, the magnitude and the amount of energy that type of event or could impute to the situation and in the markets in general, would be price supportive for gold. So there's a lot of variables, a multivariable situation that ultimately at the end of the day determines the net resultant trajectory of any market, but gold in particular, certainly. So anything and everything that would certainly, where there's uncertainty, fear, or the combination, that will tend overall to be price supportive for the precious metals, gold, silver, and platinum. If people, from a capital flow standpoint, if traders get spooked and feel that the stock market is nearing a top, well, if money flows out of equities and into treasury instruments typically first, and then secondarily into the precious metal sector, and that would tend to be, there's inverse relationships there as well. Okay, next question. Did I expect a pullback of its magnitude from July 6, 2016? Yes, but remember, Griff is asking that. Yeah, but remember that slide where I said it a year ago, or back in the middle of, the third and fourth quarter. Where's that? My answer is, yeah, but I didn't expect it would continue. So if you're saying, did I think it would be as deep? No, clearly not. And because, remember, I thought it was a bull flag. Let me show you that chart. That's why I put it in there, just to show you how my view changed. You're talking about this period after we hit that top in the middle of the middle of 2016. That's July 6th, that top there, and we had this little triangular pattern. I was thinking that the move from number 4 through number 5 was your wave 3. All this stuff was a little fourth wave bull flag, and when you have a bull flag, you would be expecting a breakout to the upside. So that was outlined. Let me see if I can go get you this chart. That's why I put the little triangular lines on it to indicate I was seeing a triangular structure, which I was. If this is the end of what was at the time this was a year ago, whenever I did this presentation, that I was thinking this is the end of wave 3, this is your A of the triangle, the B of the triangle, the C of the triangle, the D of the triangle, the E. I was expecting this is the new breakout of what would be wave 5, but it didn't happen. So the answer to your question, Griff, is no, I did not expect the magnitude and the precipitous persistency of this thing to keep going down the way we see it ultimately did. I thought it was going to break out through the upper side of this triangle because I thought it was a bull flag configuration. How wrong I was, clearly. But that's what, but I didn't, the technical strategy would be, if you want to play it safe, if you want to be conservative, wait for a breakout of that upper side of the triangle. We never saw it. So once I saw the market break down below the lower side, you have to quickly adjust your view and your interpretation. You can't buck the trend. You can't. A model can tell you a market should move, or a series of relationships or price patterns, etc., or indications in total could tell you, a market should move in a certain way. Well, it either will or it won't. For you to maintain your view in spite of price action that's contrary, au contraire to what you're seeing, is insanity. You have to adjust because the market's always right at the end of the day. It's a cliche, but it's a cliche based on substantial, relevant, objective information, and we want to go by that. Okay, so clearly my quick answer to your question is, I did not expect, here's that triangle stuff right here, and then here's the bottom of the triangle. It looks a little different from the chart, the previous historical chart, because different contracts, that's why, but more or less, this is the A, B, C, D, E. Here's the move where I said at the end of the chart that we just looked at. That didn't show the rest because it hadn't formed yet at that time. I was expecting the market to take off in what would be the wave 5, then have all this stuff form. It happened differently. This was actually, in retrospect, this was not the end of wave 3. This was the end of 3 back there, and this was the 5. And as such, there's a logical explanation as to why we saw the deeper decline and fall in significant 78.6% decline, creating that perfect Gartley structure in gold prices in retrospect. Okay, so yeah, at the time I did not expect it, but once it broke through the triangle, I had to adjust my interpretation accordingly and then adapt a view that was consistent with what the real world was presenting. Okay, we are technical traders. Based on this naming stock market rally as Trump rally, market sense in Clinton or Trump the outcome was already established long time ago based on technicals. Am I right? Let me make sure good question, I think. Let me just make sure I get it, because want to make it flow. Based on, we are technical traders, okay. Based on the naming the stock market rally as a Trump rally, yeah, which a lot of people, I think, guys, technically, I should have, had I known you were going to have that question, I am bullish the stock market, and I got bullish because I had well, I'm going back, for those of you who have been to the last webinar I gave in the end of, or a few months ago back, I had a time point for the stock market November 4. And I had over 90% confidence. If you look on a chart, I don't have one in this presentation. If we look on a chart, you'll see it was a perfect projection. And then I realized when I made it, it was months before, because I'm thinking back now at the time I was doing my work, and I projected November 4, and I actually projected dates out into the future. As I mentioned earlier today, guys, my next significant time point for equities in the United States, the stock market, I trade the ES, but any of the major stock indices, the Dow, the NASDAQ, the Russell, SPY, SPX, any of the major equity sectors or markets, there are going to be differences. The Dow is not moving. There are divergences, but more or less the geometry and the time-price relationships are very similar. That's why I typically start with that. And then I filter in and look for the fundamental events to unfold in the world the way they will, and look and see if they're consistent and in alignment with my technicals and what the charts are saying or not. To the extent that they are, I am essentially identifying alignments and convergences that augur for higher probability strategies. But if they don't, then I hesitate and I look elsewhere. But to your question, a primary factor as to why I established longer-term longs in the stock market was because I had that turning point projected theoretically months ago. At least at the beginning in September, I had projected November 4 to be a major turn in market. So if you look on a chart, you'll see what happened. in any major index. And I realized as I got more and more close to that point in November, I forgot the election is the following week, the 8th. Or whatever day it was, the 8th or the 9th, if I recall. And you'll see all that volatility, that big tail or candle, if you're looking at it on a big intra-period range due to the uncertainty of what was going to happen. So since then, we have seen a bidding up of stock prices. Yes, and as such, the market has been designated colloquially the Trump rally because the stock market in general has responded positively. Okay. So let's see, your question is, the market rally has been designated as the Trump rally. Makes sense. In Clinton or Trump, the outcome was already established long time ago based on technicals. I always jokingly tell people and traders that I talk with, I like to test the veracity and the potential accuracy of my technical analysis by kind of purposely being out of the loop of the fundamentals. I don't look at fundamentals, but you can't live in the world. I'm aware of them. I look at them when I want to look at information, technical, fundamental, quantitative. These are just labels to designate the type of information or the source of the information that you're utilizing. What's important is I can't trade fundamentally. I don't know how to be consistently. When you trade technically, when I trade technically, I've found that I am more reliable and I can trust in it. But the best of all scenarios, it's kind of like a coworker of mine used to say, what's the sound of one hand clapping? When you get convergences among different sectors and different types of, in this case, information sources, that's when you tend to correlate and locate higher probability setups and scenarios that are unfolding. So, but your point is, again, to get into the question, I don't mean to be so long-winded. Yeah. The structure of the S&P or this broader stock market, I believe we are in an internal fifth. We're in the final leg of a generic bull market that's lasted for years. So, yeah, to the heart of your question, I do agree that without going through the details, I still expect higher prices minimally through the end of this month. My next time point again is January 31st, February 1st, that little window, 2 or 3 day window, however many days that is. And overall, I expect the trend to continue higher into that point. After that, I'm not certain. I'll have to see as I get more proximal to the end of this month. But yes, clearly, based on the confluence of everything I feel is relevant and what is serving to, as instigators and drivers of the market, I was expecting rising prices. And so I remember I was on a radio show a couple of weeks, 2 weeks before the election, and as a final question, they asked all the panelists, who do you think is going to win the election? When it came to me, I said, I have no idea. Even though I had an idea probably, but I said I am very confident whoever wins, the market will like it. And the reason I could and I said I'm 90% confident whoever wins, Clinton or Trump, the market will respond positively. And that was for technical reasons. So yeah, I clearly agree with your premise. The technicals rule the day, and having established a technical scenario, that more or less predisposes me to angle my my perceptual apparatus to the fundamental wind, as it were, to determine the generic type of events or fundamentals or news that would be consistent with what my charts have already presented is very likely going to occur. Okay, I always have a hard time when commodity like gold goes up, but in the stock market going down. That's why whoever's saying that, yeah, this is why I mentioned, and I glossed over it at the outset, I typically have a lackluster response. The same radio show I was on months ago when they asked that question about the election, I was on just 2 weeks ago, and they asked a question about how do you see gold and precious metals as a trading vehicle? And 80% of the time I don't. And for partly the reason you're indicating, Trader R, it's, and there seems to be, how I stated to someone yesterday, there's a large percentage of the retail trading community that is enamored with gold, the quote-unquote gold bugs and everything. I am not, unless I am. And it is because specifically in this window right in here, I see specific cyclical and technical factors, price-time relationships that are saying, aha, normally I don't see gold as a good instrument to trade. I spend 80% of my activity is in Forex and in E-mini S&P trading. Not because of any particular intrinsic bias, but because they're, for various technical objective factors, they tend to be good instruments, and I earn the majority of my living from that. But every now and then, as a long-term position, I did very, very, very well in the early 80s, 83, end of 83 into the first quarter of 80, and into the end of 84 in silver. In a 6-month span, the best portion of my entire career in silver. So there are periods in time, every now and then, maybe more than now, when I see an aligning of varying factors that make for what really are, I expect, greater than typical trading opportunities in the precious metal sector. I think we're about to embark on one right now. Is it an exception? I'm still long-term. If you look at the monthly chart, which I didn't put in because for time factors, we're still, I think, in a bearish market in gold. But within that, I think we're in a portion of the smaller set of cycles that will serve to bid it up considerably in a manner that would generate some interesting reward relative to risk opportunities of return. That's all. So I agree with, again, commodity like gold goes up, but when stock market going down because of the simplistic correlation, mining companies are a small part of the market. Yeah, I agree with you, Trader R. But this, I think, is one of the exceptions to that general rule. Yeah. So very good, guys. Any other questions before we call it a webinar day? Well, if not, again, it's been a pleasure once again presenting my latest derivations and specific to gold. And if you have further questions, you can again contact us here at Pacific Trading Academy, 800-339-8588. And you see the website as well. You can get more information. Peter Newman and Frank Cameron are the two contact people that would be relevant, and they handle a lot of the questions pertaining to what I do. And once again, until we meet again, I wish you great weekend and profitable trading in the days and weeks and months to come. Until next time, have a great one. Bye-bye.